welcome to the Monday Futures Market Outlook for February 13th, 2012. This is Patrick Srezna. For those of you that have not had the opportunity to try out the eMoneySource.com trading room, complimentary memberships are available on the website. As always, we start off with the U.S. dollar index futures, and we've been analyzing the U.S. dollar that spent the better part of January consolidating lower. We were anticipating support levels being tested around the 78, 78.50, and a lot of the retracement zones that we're watching fall into the 77.50 to 79 level. We saw little attempts for the U.S. dollar to try to rally on Friday, but overall we anticipate that U.S. dollar will find support levels in this level, but not necessarily immediately break out higher. Even if it does break out higher, it may not necessarily have the follow through. It may still come for one more retest of those lows before we see a more sustained rally in the U.S. dollar come March and April of the year. When we take a look at the euro, which is one of the most important crosses against the U.S. dollar, we've obviously seen the euro bouncing off of its 126, 127 lows for the last month or so. Really, at this stage, we do actually still think that this current wave will still keep pushing higher, even if there is a temporary sell-off down to 130 on the euro. We still think there could be a push up to the 134, even 135 levels in the upcoming month. Overall, though, even though we're sort of anticipating even further strength in the euro, we are big picture bearish. We feel that this pattern will fail eventually and force the euro to have a substantial drop, but we don't believe that that has to start this month. And so while we're short-term optimistic that the euro might go higher, we're still bigger picture bearish. Next year, when we take a look at that 30-year Treasury bond, it's been really stuck in a distinct channel between the 140 to 145 level, up and down. We continue to, at least on the short term, anticipate the 30-year Treasury bond to actually break this support line and head maybe even for a test of that 134, 135 level down below. As money right now continues to flow into risk assets and away from these very low yielding defensive assets. Overall, that there has been lack of follow through on that, but we still think that that move can occur. In the bigger picture, and then especially in the second half of the year, we believe that bonds can still have a substantial rally, but it will probably occur after the stock market and risk assets have finished running their course over the next couple of months and pushing to upside targets. And then as money leaves or rotates out of the stock market, we'll probably see a bigger picture rally in the Treasury bonds yet again, probably in the third and fourth quarter of the year. Next year, I want to take a look at copper futures, and with copper, we had an attempt for it to bullishly break out above this 380-390 level and almost immediately reversed it. At this stage, we still feel that copper has room for a consolidation. We're still targeting the 360-370 on a pullback. Then, but that will probably emerge as a buying opportunity on copper. At that juncture, copper may come back for a double top retest of the highs, or maybe even push up to 410, 420 on the upside. In the bigger picture, if our forecast for a strong dollar and weak euro come in, commodities will be creating topping formations up along these levels in the upcoming months. But again, that's not a February story. That probably will take even the month of March into April to really play itself out before we see some much more bigger picture trend moves occur later this year. Here, when we take a look at crude oil futures, sort of a love-hate relationship with this chart. Everything still remains relatively bullish in terms of the pullbacks being contained to the 96, 98 level, and even developing a flagging formation like this that could bullishly break. But overall, it's now been well over a month that oil's been consolidating, and there's just really been no follow through. So it's sort of hard to, at this point, believe that the bulls that were completely in control in October and even in December, whether or not they have the momentum to be able to actually break this out bullishly on the upside. At this stage, we will probably attempt to take long crude oil on these breaks, but we really will need to see some substantial follow through in order to stick with the trade. Otherwise, if we see an attempted breakout above 101 and then suddenly a reversal back to 98 very quickly, then it will continue to show that the bulls and the bears are sort of locked in a very sideways range-bound environment that with very little conviction. Next here I want to take a look at gold futures, and gold really kind of traded right up to the top end of that range around 1770 and then tried to sell but really hasn't. Overall, we've continued to see this little sideways consolidation. This in fact could bullishly break. If gold here can hold this above 1700, any turnaround and break above 1750 that holds could very quickly come right up to 1800 for another retest of that high. In the bigger picture, again, we are not big picture bullish gold, but on the short term there's no denying that there's momentum that could still actually see gold attempt to push to a little bit higher highs along the way. So continue to watch for those breakouts. This brings us to wanting to analyze the S&P 500, but before we look at the daily charts, we always like to take a quick look at the big picture. And what we did here was look at a chart about 30 years out in duration with an 80-week moving average on there, which depicts the bull and bear market cycles that the market has gone through. We obviously have now an 80-week moving average that is trending higher, and we are trading above it, but we obviously did have a little bit of false signal chop along that zone. We are approaching those key highs of 2010, 2011, and where the market at this point is either going to break above it or not. We think that the market obviously on the short term could take little breathers, but if we can exceed those 1360, 1370 levels on the S&P on the upside, we could see not only 1450, but theoretically we could see a very bullish push even up towards the highs at 1500. We don't want to be overly optimistic, but we don't want to be bearish here either. We think that even the next 3, 4, 5 months in the stock market remain relatively optimistic for some further follow through. Now, when we take a look at the daily charts on the S&P 500, while we remain optimistic on that weekly chart for the next couple of months, one must recognize that we've finished measured moves on the upside, and we've now hit some substantial overhead resistance around this 1340, 1370 level, where all those highs last year occurred. And really at this stage, we do believe that some sort of a 4, 5, 6 day, maybe even up to a 10-day market pullback is at some point would be inevitable. That would be a profit-taking cycle that would emerge as a buying opportunity. Now, whether Friday's sell day will emerge to have been that starting point, or whether the market first has to spend another week even trying to break to higher highs and maybe testing you in 1360 on the upside before that correction begins is not 100% certain. But at this stage, the risk reward of trying to push a little bit more out of this on the upside without first waiting for a market pullback is a bit of a stretch, and the risk reward proposition is very poor. At this stage, even though again we remain bullish and we're not in any way trying to look for a major shorting opportunity, we do believe that the best buying opportunities will have to come off of pullbacks first, and so we're not actively accumulating stocks into the strength. Just summarizing our key intermarket observations. On the short term, we still believe the US dollar could go lower. Commodities we're relatively neutral on. Bonds we remain with a bias lower, and we still think over the short term, in terms of a month or two, the stock markets can actually still proceed higher. But from our 2012 market forecast and our long-term outlook, we are actually bullish the US dollar and believe that things like the stock market and commodities can do poorly in this a bigger picture environment. But that long-term picture is starting to become quite apparent that it's going to wait until probably even late second quarter, if not the third and fourth quarter of the year, to really start seeing that trend emerge. So our long-term is really long-term, and short-term right now staying long stocks and even taking carefully some commodities long all remain relatively a good trade. That was your Monday Futures Market Outlook. Thank you for joining me.